Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about, let's say, 15 minutes here. Had a little bit of technical issues today, and I scrambled. Let's just say that I kept trudging forward and decided to make a small PowerPoint of the trade that I really liked this morning. And the market is now rocking and rolling on the stock, but I wanted to keep going with it. All right. So I I'm going to run to a PowerPoint and I'm going to set up the trade based off of recent market conditions, and it's in Micron Technology. I decided I want to get a little bit more aggressive with the butterfly strategy that we've been using around earnings. And we got Micron Technology announcing 14 days away. It's on March 18th after the close. So I want to do a longer term, wider open wing butterfly. And so that's just going to be the strategy today. I was looking at Broadcom, but the issues kind of prevented me from doing it. So let's at least get one solid trade out there that we can act upon. Now, once again, these are always meant to be paper trades. When we're looking around earnings, they're very speculative. I always need to know what your goals are inside your portfolio. So let's run to the PowerPoint. And just highlighting that Options Guide TV is every Monday, Wednesday, and Friday at 11 a.m. We're going to be changing things up a little bit. And I also wanted to highlight that because we got the time today. But ultimately on Fridays, we're going to turn it into an education Friday. So we're going to be doing our trades on Monday and Wednesday. And then when Friday comes around, we're going to look to start building a course on the basics of options. So if you have anybody that's new to options trading and would like to tag in that would like to learn more about the basics of options, please let them know of Options Guide TV. And that's what's going to happen on Fridays. We're going to dedicate it to beginning option traders. All right. So I'm going to do a quick review because I had it inside the slide deck that I'm going to use today. I had, I don't know why that. Okay, I guess I'm doing it this way. So I had this set up, and I thought I'd take the time to actually go through the difference between a standard butterfly and open wing butterfly. So on the butterfly setup, I think the profit and loss graph kind of tells the story. Butterflies are very interesting trades when you look at the profit and loss graph at expiration. So in our example here, when you're looking at a butterfly, a lot of people will center where the stock is at based off of the strike price that you're selling, which is the middle strike in this instance. We're going to use call options today, and we're going to lean a little bit to the bull side in Micron Technology. But many people will look at it as a neutral trade, that they want the stock to stay here. If at expiration the stock closes somewhere near the middle strike, you have a ridiculous profit relative to the risk. Very hard to pull off because it has to stop right at that middle strike. Now, some people will say, well, if I want to be bearish, if the stock is here, I'm going to move that middle strike to the downside, and I'm going to lean bearish, and I'm going to use puts, because the puts would be out of the money and they would be the cheaper option contracts, usually tighter bid-ask spreads. So that's why you would do that. And if I want to get bullish, I'm going to lean this direction. I'm going to take my center strike and put it here. And then if I do that, I'm going to use calls. They'll be out of the money. And I'm going to use that position to try to get bullish on the underlying stock. Now, what I have done to modify a lot of the butterflies when I want to be directional, and I don't even really think of it as an alternative to a butterfly. I look at it as an alternative to a long call spread, where I buy this one option here and I sell only one option up here next to this strike. Okay. So in this instance, we're going to lean with calls. So if the stock is trading right here, we're going to lean this way with our Micron Technology call butterfly. And then the short spread, which makes the butterfly really cheap, which really lowers the potential loss on the butterfly, we're going to stop short. And we're not going to we're going to bring in a bigger or less of a credit, which means we're going to pay a bigger debit, but it's going to open the wing and make us profitable if we continue on the upside. So hence it looks a lot like a long call spread. So here's the way the trade looks. Okay, now all of a sudden I can move it with my arrow. So this is what an open wing looks like. And here's what the difference is. Remember, we said the stock was trading somewhere around here. We're now going to move it up, make this our center strike. So we're looking for the stock to make a positive move in Micron Technology. The long call spread is the driver. This is what's going to make us profitable if we're correct on our forecast. But we're going to pay more for it. Notice this gets a little bit more red, if you will, on the downside. And by doing that, anywhere from the break even on up at the expiration date, we're profitable. So it takes out one aspect of the butterfly that makes you not profitable. Now, if you're going to be wrong, you'd rather do the standard butterfly, right? Why? Because you just don't have as much at risk. If you're going to be right, well, you got just as much upside. And if you're even more right than you wanted to be, and the stock ends up way out here, you're still okay on the trade. You're still making a decent profit on the trade. And that's what I have termed the open wing butterflies. Matter of fact, it's going to be a new strategy that I'm going to add in the new playbook, the options playbook version 3. And it's just a modification that I kind of have came up with over the years, from just looking at skip strike. And butterflies are just very interesting because of the potential to sell 2 of these option contracts and bring in all of that premium by doing it. So I've always found butterflies to be interesting. Okay. So in our trade, and I just grabbed this and put this together literally 5 minutes before we started Options Guide TV today. As a matter of fact, this needed to be switched. So let's do that. Let's just make this slide right here, and we'll start from the beginning on Micron. We're going to look at Micron Technology. This was an SPX butterfly, but it's not anymore. So now it's going to be a Micron Technology. Now, I had the trade set up from this morning, but Micron right now is up 22 points at this point in time, up about 6% on the day. Markets are very mixed. Can't really decide what sectors we should be in, we should not be in. I mean, they're really taking the conflict in Iran as an opportunity to just flush out all of their portfolios. So today's date is March 4th, 2026. We're going to look at doing a Micron Technology open wing butterfly before their earnings report, which is 14 days away on March 18th after the close. Micron was trading right around 460. We came in and we're going to buy to open one of the Micron March 26th expiration 410 calls. And that right now is 23 days away. This is the March 27th, 2026 expiration. So I apologize that the 27 is before, the 2026 is the year. That is 23 days away. So we're going to buy one of those. We're going to sell 2 of the Micron 460 calls. So this is 40 points wide. And then we're going to stop short on the one that we buy. It's going to increase the cost, but it's going to open up our wing. And we're going to buy the 480 strike call. 40 points. That means the maximum this can make is 40 points. On the downside, if the market continues on up and trades above 480, we're still profitable on the trade. We can get this done for $13.13. So it's a real trade. It's got real time premium. We're going all the way out to after the earnings report on the 18th, going out to March 27th, $1,313. Now, here's the beauty of the open wing. If this is 40 points wide and this is only 20 points wide, that means that if the market does blow through the strikes to the upside after their earnings report or prior to, it could happen prior to, as we're seeing today, up $22 at this point in time. If that does happen above 480, the butterfly still has to trade for $20. So we're putting it on for $13.13. So 20 minus 13.13 means that we're $6.87 in profit on the trade, or $687 per 1x2x1 open wing butterfly. Now, if the market goes out right at the middle strike at 460, the maximum we could make on the trade would be 40 minus the 1330, or the total reward per 1x2x1 butterfly would be $3,687. So we're risking 1,313 per butterfly. We could make a maximum of 3,687. If it blows through the strikes above 480, we can still make $687 from that point on up. And whenever we look at this trade, then we're thinking 460 the max upside. Oh, we got more max upside. So this is 50 points wide and this is 20 points wide. Okay. So the max upside is 36 through here. And we're still getting this done for $13. All right. So I did my math wrong. I think we could even go in and let's just start this from the beginning. If we got we're looking to do the Micron open wing butterfly March 4th, 2026, Micron around 460. We're going to buy the 410 call, sell 2 of the 460 calls, and buy 1 of the 480 calls. This all has the March 27th expiration, which is at this point 23 days away. So if we do this on this butterfly, we're 50 points wide on our long spread, and we're 20 points wide on our short spread. So if the stock goes beyond 480, we can make 50 on our long spread and only lose 20 on our short spread. So in that instance, this has to trade for at least $30 if it's above and beyond the 480 mark. So if that does happen beyond 480, we would be up $30 minus the net debit paid, $13.13, or $16.87. Real nice risk reward here in this situation if we blow through all the strikes. So per 1x2x1 butterfly, we would be up $1,687. Now, our max risk is $13.13 or $1,313. So if the market goes below 410 in that instance, we can lose that maximum on the trade. So if we put this whole trade together, we're looking for a strong move going into earnings. We have 23 days until that expiration date. A real solid risk reward on the trade. We need the market to kind of stay where it's at or drift higher from this point in time. We got Micron trading right now at 401. This isn't right. 460 is not right. We're trading at 401.87 at this point in time. So we need to drift higher beyond the 410 market and land somewhere between 410 or 460 to basically make a home run on the trade. If we go above 480, we're still solid on the trade. All right. That was an interesting trade in Micron heading into earnings. Micron Technology right now is trading at 401.66. All right. Any questions? I apologize. Obviously, we had a scramble here to try to get this trade onto a PowerPoint. I was thinking I went 40 points wide, but we went 50. And I don't, and that's a solid number. I was trying to get it down close to $1,000 of net risk on the trade. If we did the 450, if we move this 10 points, so the at the money straddle going out, we'll say how many days we got to expiration? We got, or to earnings, we got 14 days. Okay, so the March 20th 410 calls is 28. So we're looking at about an expected move of around $66 approximately, around $66 to do that trade. So 50 points is well within the range by that expiration. That's just the expected move after earnings. Yeah, let's stick with the 50. Trying to decide if you didn't want to risk that much for the basic trades. I mean, we could go, I'm going to look at this real quick, like could go 410, 460. We'll bring that down to 450. And then we'll go 470. And yeah, that gets down to $1,000. All right. So if you adjust it by 10 points, you do the 410, you're buying the 410 call, selling 2 of the 450 calls, and buying 1 of the 470 calls. In that instance, your max profit above 470 is going to be adjusted because this is only 40 points wide as opposed to 50, but we get the total net debit down to $1,040, to $1,040. So that's not bad. That knocks $300 off of the trade. The risk is obviously if we get some more downside, if we get downside movement, we end up below 410 by that March 27th expiration. But I do think that, we saw Micron Technology go through a period of consolidation. The last, I'd say almost the entire month from just looking at the chart. And now we're getting a little bit more momentum, a little bit more of a bounce back. So I decided that I wanted to do this trade today. We'll look at a very short-term butterfly, probably right at the earnings. So a little bit, 14 days away, we'll look at doing a shorter-term, more speculative Micron Technology trade. Now, this is, to me, is the alternative to doing a long call spread, where you maybe buy the 410 and sell the 460, or buy the 410 and sell the 450. This is an alternative to that. It's going to be cheaper. You're going to have less upside if you blow through the strikes to the upside, but you also are going to put it on for a lot less cash up front, meaning you have a lot less risk if you modify this and do the open wing call butterfly. I don't see anything in the chat. Apologize for the scramble today. We'll be back. Well, we'll be back on Friday, looking to do another. Well, we'll look at earnings. We're going to head into Fridays, starting to look at doing education Fridays, which are going to be based off of basic option trading to start. But it's going to be a progression, and we're going to be using the Tradier Pro paper trading platform along the way. So we're going to not only teach you about options, we're going to actually teach you how to trade using a paper trading platform. So with that said, my name is Brian Overby. We'll see you this Friday for the next edition of Options Guy TV, 11 a.m. Eastern Time inside the hub, hub.tradier.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.